All of us have heard about Rajnikant, the film actor, the superstar Rajnikant. Rajnikant actually has had some very humble beginnings. I'm very privileged to be in the company of a person today who started off with some very humble beginnings and today is leading a very, very big organization.
Debt markets are as large as the equity markets, yet they rarely get attention. Stalwarts like Balasubramanian have helped build these markets quietly over years. This is the story of how India's debt markets took shape, only on MF Chronicles.
We see a lot of action in the debt markets now, but it is not what it is now that it was earlier.
The return on bond market that is generated is real. There is no illusionary. So that's the way the bond market used to be always bigger. The certainty of making money on bond market is far higher. So I'm happy I started a bond market guy.
You have been one of the biggest votaries that I have seen of promoting mutual funds as a catalyst to improve the depth of the debt markets.
Mutual fund fiction schemes open the gate to participate in the market-driven portfolio, like an equity. That is the time I think the people started seeing the power of mark-to-market can give you gain in a falling interest rate scenario. Therefore, liquid fund became the large animal. So even today, I tell a lot of people that mutual funds have been responsible for creating a orderly bond market yield curve in the country. Is no one else other than mutual fund.
I think the period 2005 onwards was particularly fertile because we started seeing, or maybe just around that time, a lot of variants of debt funds coming in. There was a short-term plan, medium-term plan, floating rate plan, an FMP. What was the thought process in the industry for creating these categories?
A fund manager can go crazy to buy a 10-year, 20-year bond and carry high risk and still generate high return or lower return, whichever way market moves. So then risk is unknown. Whereas somebody who is coming to you knowing that risk is coming without knowing what the impact is going to be. So then you have to also find a product which will fit the risk appetite of the investors.
Hello and welcome to yet another episode of Mutual Fund Chronicles. We've been bringing you some of the best minds in the industry, and through their anecdotes, we've been living through 30 years of the mutual fund industry. In our earlier episodes, we covered the first decade, which is 1995 to 2005, actually pre-2005 if you will. But you'll find that most of the guests which come in have actually lived through the 30 years of journey. In fact, today's guest is a very special guest, a very dear friend of mine. I've had the privilege of working with him earlier, and he's actually seen the evolution of the mutual fund industry from very, very close quarters, specifically from the debt markets perspective. To give an analogy about the guest before I introduce him, all of us have heard about Rajnikant, the film actor, the superstar Rajnikant. And Rajnikant actually has had some very humble beginnings. I believe he started off his career, if you will, as a bus conductor and became the superstar that he is. I'm very privileged to be in the company of a person today who started off with some very humble beginnings and today is leading a very, very big organization. I'm talking about Balasubramanian. To me, to all of us who are close to him, we call him Bala. So much so that, if I may add, we don't call it Birla Mutual Fund, we tend to call it Bala Mutual Fund because he's been associated with the mutual fund for so long. From a dealer in 1994 to the CEO and MD in 2009, in 15 years flat, I've seen this person grow in stature, in his knowledge, in his wisdom, but he still stays as grounded, as humble as ever, and more importantly, as knowledgeable. Thank you so much, Bala, for coming in here. It's a pleasure welcoming you to MF Chronicles.
Thank you, Vikaas, for having me part of the discussion. So we know each other as industry friends. So also happy to see in your new avatar as an anchor, as a quiz master kind. And so thanks for having me part of the discussion today.
Thank you. On a lighter note, you know I always like to ask uncomfortable questions. But let's just dive straight in. I was mentioning in the opening part that stalwarts like you have actually seen the whole industry grow. Okay, a lot of attention in the mutual fund industry gets directed towards equity, and that's something which is a natural sort of a muscle memory thing. Everybody wants to talk about cricket, Bollywood, and equity in this country, right? But the much bigger market, the much larger market that we are talking about is the debt market. We see a lot of action in the debt markets now, but it is not what it is now that it was earlier. In the early 90s or the mid 90s, when you started off your career, it was a very, very different place, Bala. Before we start, could you just give us some lay of the land, a landscape? What were you operating in? What are the systems, processes? how we're dealing with people. It'll be good fun to know for all our viewers.
So I think what you said is right. I think the bond market in general is always bigger than the equity market. So today, equity market, people measure the size of equity market to the market cap. If you add up all the bond market outstanding, whether it is the government bond market outstanding, corporate bond market outstanding, not just only in India, worldwide, the bond market is always much bigger.
Correct.
Even from the bank's point of view, it was one of the large contributor to the economic growth. And the bank, the main job is to, of course, take deposits and lend. And both of them are related to the bond market. It's a yield curve on these matters. Therefore, historically, if you look at the bond market used to be the large market. Even today also bond market remains a large market. Secondly, when we started off, even as the Personal Mutual Fund, even the mutual fund industry, while equity schemes used to come as a diversity equity funds, the initial launches for most of the funds used to come from the fixed income market. The reason is bond market was big, and bond market used to give returns in excess of, it used to give return in the range of about 18 to 22%. There was a period
Can
where
you repeat that again? I think most people will not still believe it.
18 to 20% was a coupon.
Coupon.
So I used to lend money to people at 25%. I still remember having lent to the GE finance company in India. It's promoted by GE Overseas, which is based out of US. And they were looking at expanding the business in India. And they came to the bond market for borrowing. I remember having lent to them at 25% with the GE guarantee from US.
My goodness.
So it used to be,
And which year was this?
it was in the year 96.
96, sir?
96.
Wow.
Even Kotak Mahindra Bank, before it got converted into the bank, there was Kotak Mahindra Finance. There used to be a JM Finance.
Yeah.
And there used to be a Inam Finance. All these NBFCs, Apple Finance used to exist. So all these NBFCs used to borrow at ranging from 17% to 20%. And we used to be one of the lender. So the bond market, I always believe the return on bond market that is generated is real. There is no illusionary.
Yeah.
So any return that is generated in the bond market is real. In the sense, if I say I'm giving to somebody at 100 rupees, I'm giving, 1 crore I'm giving, I'd say earning about 17% return. The only difference is whether it's a monthly or quarterly or hourly payable or annual payable. That's the only difference that comes. The coupon is 17% only. That money that comes to you is real. The 100 rupee money comes back. That means the total return that you generate on the 17% real return that you get. But equity is return is illusionary. So it comes, you have to wait and you have to wait and we have to wait. And then earnings has to come. Therefore, the return got generated on equity by way of company earnings improvement happening. After paying all the interest that is payable to other obligations. That's the way the bond market used to be always bigger. The certainty of making money on bond market is far higher. Therefore, there is a period where people are looking for certainty. People are looking for more like a guaranteed kind of return and so on. That's why the bond market always used to be very big. Even today, the bond market is big. In fact, equity market as a cult got picked up after the change in the taxation structures. This only if you make one instrument bigger than the other instruments, either by merit or by tax consideration. The moment the tax consideration came for equity, which is if you hold it for 1 year, zero tax and no capital gain tax. Whereas bond market doesn't have the luxury of this benefit. They used to have the indexation benefit used to be there. That's the way I think the equity market became superior to bond market because of the tax treatment that was being given to the equity market. The advantage on bond market, rather advantage on equity, once you give money to somebody on equity, not necessarily that you give up the risk. Every risk that a company runs is your risk.
Correct.
Whereas the bond market, every risk the company runs is okay, doesn't matter to me. My risk is actually related to the company's survival. Only after making all my interest payment only, he can actually service other shareholders. So that's the principle. If we take the first set of defense, we'll call it. If I lend money to somebody in the form of fixed income, he is obliged to fulfill all the obligation to me first as a bond investor. Then comes the equity investors generate profit.
Correct.
That the superior nature of servicing of the debt always remain as a key success for the bond market. So I'm happy I started the bond market guy.
Yeah.
So when there used to be, it was a market where even the overnight lending used to happen at ranging from 15%, 20%.
Overnight lending.
Overnight lending, which is basically the banks are supposed to borrow from banks, from each other, from the market participant to meet the statutory requirement, which is called CRR.
Mm-hmm.
There was a period where CRR used to be high, the range of about 10-12%. SLR used to be very high, 35%. So the rates were dropped. And during the period, if you have to maintain very high SLR, CRR, then you have to borrow from the market. Suddenly, the rates used to spike. There used to be a day where I have seen 140% rate, 150% lending on a single day. I remember having lent to one of the largest bank in India, globally, sorry. They are small presence in India, which is Bank of America. I had lent money to them because at the end of the day, everyone is duty bound to meet the RBI regulatory framework. In order to ensure that they don't violate on RBI norms, at any price they will to borrow, but only for 1 day or 2 days types. From there, it actually got evolved over time to where we are today, which is one of the most developed bond market we have seen today after going through all these things. Second is, those days, even interest rates used to be administrated. When the bond market picked up, when it was administrated rate of interest, which means you fix the rate. Then how you pay the rates, that doesn't matter to anybody. But Government of India used to fix the rate, like PF, Government of India used to fix the rate. Then we moved away from fixed rate regime to the floating rate regime, through the administrative regime to the non-administrative regime. When EPFO, if you cannot earn 12, then how will you give 12? If you cannot earn 10, how will you give 10? So this concept came in, I think, post 1992, the financial market global crisis. India went into the economic crisis at that point of time. Then that is the time when the whole bond market got developed. Then you set the expectations. The way what equity market do you actually expect earnings to improve, therefore equity price will go up.
Correct.
Whereas the bond market, how liquidity improves can have impact on the bond yields. How the interest rates will be cut by Reserve Bank of India or increased, whichever way it is, depending upon the inflation expectation and so on and so forth. It's called a monetary policy.
Correct.
Then they start becoming a driver of bond market. Bond market point of view, I call it as a MABAP, I call it is the Reserve Bank of India. From equity market point of view, MABAP is a SEBI. So the way the whole divide got created. And today, for the bond market, there are two set of people. Only the Government of India, all the bonds which are outstanding is as controlled by Reserve Bank of India, and money market instruments. All the bond market which is issued for the purpose of building the balance sheet by way of funding their growth, like in equity, that comes under the SEBI as a regulator. That's the way all these things got evolved over a period of time.
So in a nutshell, you've actually given the whole primer of how the debt markets start off, how the debt markets function. My question, Bala, to you is, in that period, actually there are two parts to this question. One is relatively simpler. The other is a little bit more, you'll have to probably explain it in a little bit more simple way. You have been one of the biggest votaries that I have seen of promoting mutual funds as a catalyst to improve the depth of the debt markets. They were very, very shallow. I remember, in various discussions with SEBI, in various forums, you have been very confident. I'm talking about those days when income funds were hardly anything, hardly any size. Since those days, I've been hearing you talk about the fact that this is going to be a very big catalyst for the development of the debt markets. Okay. How have you seen the evolution? That's question 1B. Question 1A is, in a market which you just talked about, where mutual funds were insignificant players at that point of time, right? Not as significant as probably what other institutions were. How did you manage things like daily disclosure of NAV, mark to market? Just give us some sense in terms of how this whole thing does. So mark to market, NAV, daily disclosure, and then how the markets have developed and how mutual funds have become the catalyst to developing those markets.
Yeah, I think interesting because when we began, there's absolutely no pricing model.
Correct.
I think there is no bond market. You invest in a bond, you carry it par value. If I give 100 rupees, if I give 100 crores or 10 crores, you'll continue to invest the 10 crores. You keep accruing interest payment. So there is no secondary market. And whatever used to influence the stock, the price of underlying bond, bond prices would have gone down. See, it's unlike in equity, the bond market is actually called as inversely correlated.
Correct.
The price is actually inversely correlated to the yield. If the yield goes up, price comes down. If the yield comes down, price goes up.
Correct.
Unlike in equity where the earnings improves, the price goes up.
Correct.
Here, inversely correlated. So there's a huge difference which everyone has to understand.
Correct.
So this was one of the things that we used to think, that why one should invest in bond market. Can you get return in excess of what you assume? The probability is that yes, because in a falling interest rate scenario, price goes up. And second is another reason why bond market exists is the Government of India itself is a borrower, big borrower. Worldwide, most of the growth in the economy is funded through the fiscal deficit.
Correct.
The moment you have fiscal deficit, you need to come to the market for borrowing. The more you have fiscal deficit, higher the borrowing.
Correct.
Therefore, higher the interest rates. It's simple as that. More demand and supply increases.
Correct.
So, more the demand, higher the rates. Lesser the demand, lower the rate. So, that used to be the concept. So, as it happens, you are running an open-end fund. We are all ready to run an open-end fund. When we started, our first fund was Birla Income Plus. And then we came Birla Cash Plus later on. The Birla Income Plus, when we started, we used to invest in 20-year bond, 10-year bond, 15-year bond. We used to struggle in terms of how do you value. The reason why valuation became important, you buy at certain price and certain yield. And that you are buying, you are locking that return and that yield and the investment on the base of money just come from XYZ investors. This is an open-end fund. The next day, some ABC investors coming in. Then after that, another set of investors coming. All the investors are coming on the base of the portfolio had been created using somebody else's money.
Correct.
So that's where the valuation came in.
Correct.
Then we said, how do you give the benefit to somebody else when somebody has to come at the today's prevailing yield, whether it is up or down?
Correct.
That's why I think we used to debate and discuss about valuations. In those days, we used to use the Lotus 123. Now it's called Excel file,
Excel
right?
file, yeah.
In our case, we used to use the Lotus 123.
The slash file retrieve.
So we used to go to Lotus 123.
Yeah.
And then there used to this thing called goal seeker.
Goal seek.
Goal seeker.
Goal
There is a provision which is even today also it is there in Excel file.
Okay.
So we discovered it with a lot of learnings and going deep dive. In fact, I must mention there was a gentleman, you of course know him, by the name Anthony Heredia.
Yeah.
Was part of our industry colleague, and he was part of our team in Birla Mutual Fund. And he used to also evening we used to sit and discuss. There's another gentleman named Venkat.
Venkat.
He used to be part of the accounting. I used to be part of the dealing room activities. We used to go and look for goal seeker. Okay, you put bond yield is 100 rupees face value, and the coupon is 17%. 5 year to maturity, half year coupon or monthly coupon. Then the yield of 17%. Today 17% has gone to 15. So goal seek is 15. 15% is the return. So what is the goal seek? Is the price you seek for the price. So if 15% is the yield is going to be, then what should be the price? So then it arrives all the cash flow get discounted upfront. Like NPV. You calculate all the NPV at 17%, you take it. Then discount it at 15%, arrive at the price. So that we used to struggle to get that. This is called YTM price.
Correct.
The base of YTM.
Correct.
So this took a lot of time for us. The initial period when we launched the bond market funds, we used to value at par value. So par value, you can't continue the par value. Then you discovered this YTM, how do you calculate the price? Through the goal seek model.
So were you the first ones to do it?
We were the first one to do it.
Okay.
Then we said, how do you institutionalize it? And fortunately, there are a set of people that point of time who started was Franklin Templeton. And Templeton was there, its game in the market. Kotak Pioneer was there, and Birla was there, JM was there, Reliance was there. These are the 4 or 5 funds. UTI was large.
UTI was
a big daddy. We used to call him UTI as a big daddy. So they are all very strong on bond market, but without knowing how to value it. Then we formed a committee which is formed by, I was one of the early contributor. I'll not say the committee member. I was a contributor to the committee for coming with output.
This was much before Amphi and all was formed.
Much before Amphi was formed. Amphi was formed in 95, but AP Korean was that time was
but this was an independent thing which is...
Independent, we formed a small group, and then we said, how do you value? We debated. Then we came with the metrics, which is the 4-quarter metrics, is to do AAA bonds and so on and so forth. If it is a 5 year, how do you value? What should be the yield? Basis the prevailing market yields. So even the bond market, the way equity market was completely opposite, even the bond market also was completely opposite. You can quote anything that you want in your mind. And except the participation in the bond market was higher than the equity market participation. Equity market largely driven by the retails and HNIs and punters.
Correct.
Whereas the bond market is completely driven by the intellectually highly capable people like bank treasuries and all. So you have to get the prices in that segment. And that's why we actually fixed the initial period in terms of development. Now, of course, got evolved over a period of time. Then CRISIL got involved, and then the whole valuation got fixed. Then second, in terms of development of the market, so one of the things that used to happen is when the bond market was not fully transparent open, when the Reserve Bank of India went through the cutting interest rates is the way to drive the growth in the country. Then the series of rate cuts started coming in. That time the governor was Dr. R. Venkatraman was there, then became Manmohan Singh, then became Y. V. Reddy. During that period, the interest rates were coming down.
Progressively bringing it.
Progressively it was coming down. So that is the time we said that bond market become one of the, bond funds rather, would become one of the largest animals. Then we started a money market fund. We never used to call it money market fund, we used to keep flexibility. Because those days, the instruments that are available to invest were very limited. So very few instruments, money market instruments are very few. We used to actually lend to the ICD, convert it into bond, and then call it the money market instruments. There is no CP as a concept, it gave a birth. CD as a concept gave a birth. So Reserve Bank of India invented commercial paper, invented certificate deposits. Then there used to be an instrument called BRDS, Bill Reader Schemes. This is also money market instrument with no liquidity.
Correct.
Then we said that we must create money market schemes. These were meant for the people who cannot take a high risk investing in long-term bond. But they are willing to take a risk, but they don't want to invest in risk beyond 1 year maturity. That's why we started Birla Cash Plus, which now is called a liquid fund. Those it used to be Cash Plus, because Cash Plus is, cash market is so much return. Plus means you get additional return by investing in. If you're investing overnight, you invest in 6 months, you get additional return.
Correct.
If you're investing overnight, you invest in say 1 year, you get additional return.
Correct.
So that's why we used to call it the Cash Plus. And the plus is actually indication of getting higher return. We cannot promise return, but it can indicate through a different means.
Yeah, I remember.
So
A lot of Birla schemes, income plus,
everything
cash
used to be plus.
dividend yield plus.
Dividend yield plus.
I remember.
We used to use that word to our advantage, and that's why the money market funds came. In fact, as the money market funds have started giving return better than bank deposits. So bank deposits are all controlled, fixed.
Correct.
Whatever the banks are saying, that's the rate.
Correct.
Whereas mutual funds started giving the market-related return. So mutual fund fixed schemes open the gate to participate in the market-driven portfolio, like an equity. And the price is fixed by the market, not by the bank while taking deposits. That is the time I think the people started seeing the power of mark-to-market can give you gain in a falling interest rate scenario. Therefore, liquid fund become the large animal. The reason I am saying about liquid fund is become a large animal, as the liquid fund becoming bigger and bigger, the demand for commercial paper issuance is shot up. I used to lend money to commercial paper for 1 year, including companies like Glaxo, Siemens, used to all borrow in those days. About 17-18% rate.
And this was which year?
This was the year of 92, 93, 94, 95, 96, the entire period.
Right.
So sometimes who would say no to a Glaxo to lend? Because it's an international US-based company, who would say no to them? But they were borrowing at 17%.
But when you launched the liquid funds and all of that, by that
the
time,
rates were high. As the liquid fund size became bigger,
it can start coming.
then all these companies coming to tap the bond market through the CP route. The demand is coming. Demand for buying is also coming. Therefore, the rates start dropping. That is the time the Reserve Bank of India achieved the main purpose of creating a bond market yield curve. So even today, I tell a lot of people that mutual funds have been responsible for creating a orderly bond market yield curve in the country is no one else other than mutual fund, fixed income schemes. And today we can take pride. I can draw a money market yield curve from 1 day to 12 months. I can draw a curve like this. Then even for government security market, you draw a curve. 1 year T-bill rate, 3 months T-bill rate, you can put one column and one axis. Other axis you put the YTM and then draw it. You can draw the yield curve. So the yield curve came thanks to the mutual fund growing their debt funds. Because the debt funds are related to the market yields, not by the fixed. There is absolutely no guarantee on returns. This also came thanks to the mutual fund discovered in the pre-94. The same Unit 64 GAC, when I was in GAC, we used to have funds called GAC Rise 1, Rise 2. There used to be in-bank mutual fund debt schemes. Boy mutual fund debt schemes were there. And all of them were guaranteed. The moment it was guaranteed, they all lost their pant shirt.
Correct.
Because they could not meet their guaranteed return, therefore they have to shell out from their own pocket.
Correct.
Then that gave the learning as to how the bond market can be developed without guaranteeing return, but through the mark-to-market. That's why the full got developed, and which I think is done quite well.
Interesting. I've lived through this, but somehow, when you're bringing it back, it's all just coming back to me. All these things which you're talking about. And yes, of course, the yield curve. I remember that a lot of discussions which you used to have. I think a lot of discussions with CRISIL also you started having in terms of the benchmarks and.
Then we roped in CRISIL to get individual. Jiju all came later. It was a gentleman named Dr. Ramachandran, professor from his time he was there, and he was the main. And there was a lady by name Rama Vasantarajan, is part of the CRISIL. Then Ravi Mohan was the CRISIL head. We invited him to help us to put a structure in place, how to value the bonds. And then his team was formed. We were all part of the team. Then we sat together, then created a matrix. We call it as a bond market matrix. So it's basically how the bucket-wise we do it. Then we kept developing as time progressed. Then as the other fund houses started coming in, then for example, Nilesh I joined the industry through the Franklin Templeton. First he joined the mutual industry through Franklin Templeton.
Correct.
Then he got involved. We're all the bond market guys. So all of them got involved. And then they build. Navneet is now part of HDFC CEO. Then he got involved. Likewise, we build the whole process continuously.
Interesting. I'm just going to step back a bit and I'm going to ask you about, since you talked so much about the bond market and you talked about some specific aspects, but somewhere along the way, you also talked about an income fund and a cash fund. I think the period 2005 onwards was particularly fertile because we started seeing, or maybe just around that time, a lot of variants of debt funds coming in. There was a short-term plan, a medium-term plan, a floating rate plan, an FMP, and there was a dedicated debt mutual fund, Standard Chartered mutual fund, which had come in. I think there was T+0 redemption. Am I right in those days?
Correct.
Can you just take us through how this whole category, because you said you were interacting with so many people and you were very deeply involved in the market. Somewhere these sort of ideas would have come in that along the yield curve, this is a good segment to launch, this is a good category to create. What was the thought process in the industry for creating these categories?
See, liquidity, when we started the mutual fund industry, liquidity was not available. You have to structure the transactions. We all used to structure the transaction in such a manner that who is borrowing from you is also duty bound to give you liquidity.
Correct.
Whenever we need it.
Correct.
So there is no guarantee of I'll not withdraw your money. So that we used to call the daily liquidity bond. So everyday liquidity up to certain extent you can give. So that's where we started.
Okay.
And as the industry became bigger, liquidity started getting generated on its own. Then as far as the government of securities market concerned, you go to the repo market for taking liquidity when we needed. In terms of structures so you have a two segment of the market. You have a Birla Income Plus, which invests across maturity.
Correct.
Then you have Birla Cash Plus, which invests up to 1 year maturity. So these two gave an idea that as if the moment you become across industry, then I am at the risk of the fund manager.
His views.
So his views.
Correct.
A fund manager can go crazy to buy a 10-year, 20-year bond and carry high risk and still generate high return or lower return, whichever way market moves.
Correct.
So then risk is unknown.
Correct.
Whereas somebody who is coming to you knowing that risk is coming without knowing what the impact is going to be.
Correct.
So then you have to also find a product which will fit the risk appetite of the investors. So otherwise in the bond market, equity market risk appetite is only one. Whereas the bond market, you can create the risk appetite differently. A conservative investors come into the liquid fund. Yeah, a little better than conservative investors can come into he will say, I'll be able to take, my money is visibility for 3 years. I want to invest only for 3 years.
Yeah.
After 3 years, I'll take the money out for my investment purpose or capital expansion purpose. Then if you go and tell him invest in 10-year bond, then he is taking a mismatch of liquidity. It's called asset liability mismatch risk he is taking. So how do you actually address the asset liability mismatch? The way bank does, if you take a 5-year deposit, you lend money for 7 years, is okay. If you take a 5-year deposit, if you lend for 15 years, that money doesn't come back. How will you repay your obligation, right? This is a simple philosophy. The mutual fund discovered that you can create a fund taken to the risk appetite. You can create a liquid fund, which is money market fund, which up to 1 year, then it became about 90 days over a period of time. Then if it is 6 months, you call it a low duration fund. Then you call it as a medium term plan, and the short term funds, which up to 1.5 years you take. Then you have floating rate fund. Because floating rate also interest rates move up, then your coupon also increases. If interest rate moves down, your coupon also decreases. Floating rate bonds came in. So for each of the category, it was created using evolving instrument in the bond market. Second is the risk appetite is always measured on the basis of what duration you take. Don't leave it to the fund manager fully to decide your fate. Every investor has to decide their fate.
Let them judge.
Let them choose whichever they want to do. I'll only provide a product. That's why the whole risk assessment was done. And the higher the duration, higher the risk. Higher the credit curve, higher the risk. So likewise, we actually defined each of the schemes which will invest in various instruments that is available. In fact, mutual fund also went to the extent of discovering a product that will invest only in sovereign bonds, gilt fund. And within the gilt fund, we had short duration gilt fund, medium duration gilt funds, long duration gilt funds.
The PF gilt fund also.
The PF gilt funds. So that's the way the whole category started. In fact, I think Indian bond market funds in mutual fund side have actually brought in a lot of innovation, taking into account duration, credit curve, and then the bucket of various rating category in which we can make investment. In fact, it came to that extent in 2016. In the credit funds, when the interest rates are very low, you always want to generate higher return. That is, you go down the credit, which is basically AAA is the rated securities. You go down the credit is BBB, AAA, AA plus, and AA and AA minus. So at each rating, your rate goes up.
Correct.
Go down the credit rating to BBB, the rate goes up by 3-4%. So how do you capture this? Through launch of schemes. So that is why the whole fixed income schemes got developed over a period of time. Innovations came in the bond market side using these kind of fund launches.
One of the primary triggers for the category building which you did, I believe, was also because you had a very savvy investor segment at the other end, which was institutions and corporate treasuries, who at one end were very yield hungry or very savvy in terms of yield hungry. They're also driving down costs. Say, why are you charging so much of fees, etc., etc. But that's a separate debate. I'm not getting into that. The more important point is that the development which happened of the bond market, a lot of people would say, is because there was pressure coming in from institutions and corporates. There was large money which needed to be parked. Even in liquid funds, I remember, Bala, you remember we created this institutional plan and super institutional plan, the same fund. So it was basis some large ticket money which wanted to come in, right? How much of a risk is getting so much of institutional money, which you have seen? You've obviously seen it as a fund manager, as a CIO, and then you've seen it as a CEO also. What sort of risk gets attached to a portfolio when you have primarily institutional investors at the other end? How do you manage that risk? One at a fund level, one at an investor level. How do you manage that?
So this is very interesting. It again got evolved over a period of time. Like institutional plan, all these things, higher the ticket size, his demand for special pricing also is high. Therefore, you used to have a different expense structures. For retail, one expense structure, institutional, one expense structure. Then SEBI came with the guideline in 2012 that you cannot have a differentiated plan for different investors. Every investor that you come to you has to be treated the same. He may be a big investor for you, but for us as a regulator, everybody is the same. Therefore, you have to have one single plan. So that's something brought in the expense structure, the streamlining of expense structures. Second is the moment everybody is equally treated the same, the whole comes, I must also know whether it's long-term investors or short-term investors. Most of the treasuries cannot be a 5-year investor. He always come for short-term gain, but I'll gain out of me and then go to then you put in exit load. So then it's say if you want to exit with it before 3 years, you'll have an exit load. Before 5 years, you want to give an exit load. We used to control it through the exit load. Second is you also put a ticket size. So you can only take so much from a single investor as a single large ticket size. A single investor cannot influence the decisions. I think it will be more dangerous for the rest of the investors. See, initial period when we are building it was okay because we are asked to have fund in building the size.
Correct.
As some funds become larger, you must pay attention to the risk evolving out of this kind of investment. Then we used to keep a structure on single instruments. You cannot take more than in certain percentage. We used to go up to 15% a single instrument, so that you have multiple instruments. Then we used to say you should have part of your portfolio G6. Then you have to assess each of the instruments which is more superior on the liquidity side. Would G6 sold in the market in crisis time, or AAA gets sold in the market on the crisis time, or AA minus will get sold in the market. Then we have to have a formula.
Correct.
Then we used to control it through how much should go to G6, how much should go to AAA. We used to have this formula. On our own, we used to create it. Then the last is actually if the money is going to stay only for 3 months, why would I take risk on something else in a 20-year bond?
Correct.
So then I restrict it. That's where the whole classification of scheme came in. In the 2003, 4, 5 type itself, this came part of our own innovation. So that once you know where to walk, once you know the guardrails in which you have to operate, then naturally keep a checks and balance on that. So that the 2 areas of risk management came. One, every investor comes in investor concentration, then portfolio concentration. Both were actually part and parcel of the portfolio construct, as well as whom will give money and what proportion you can take. Sometimes we have a scenario where you have to say no for taking money because single investors concentrate more than 20%.
20-25 rule.
20%. In our world, I always used to say, so don't say ever don't ever say no for taking money. So Lakshmi मना नहीं करना चाहिए. But अगर रिस्क में बैठता नहीं है, वो लक्ष्मी मना करना पड़ेगा.
I remember I was on the other side of the fence. Bala, why are you not taking money? This guy wants to put in money. So I've been through that.
So therefore, we used to operate in the framework which got developed over a period of time. Now it has become very robust.
Yeah. Bala, you mentioned about yields coming down and credit funds making the presence felt in 2016, etc. But I think at one point of time, FMPs were something which were the instruments to lock in yields. Yeah. So if you are willing to come in for 3 years or 5 years, or as the case may be, you can lock in because then it's hold to maturity. You can just take the money and take the yield and go away. And I think a lot of corporates patronize that. I remember there was a lot of NRI money which was also starting to come in, leveraging and putting in the money. So it was a very, very big segment. But somewhere along the line, I think the whole crisis which happened, the Lehman crisis which happened, and after that, if my memory serves me right, post Lehman crisis, there was a very big impact on the FMP segment here also. You were at the forefront. You were seeing what was happening in the market at that point of time. Can you just take us through what was happening then? Because a lot of things which happened, if my memory serves me right, it was externally enforced, externally induced, right? And we had to bear the brunt internally.
Yeah.
So can you just take us through what was happening at that point of time? Because that is probably one of the more pivotal moments after which the debt markets and the regulations started evolving much faster. As per yeah.
See, one is the bond market was growing. Actually, there was a period where bond market was bigger than equity market.
Oh yes.
And
Yes.
even equity assets and management was smaller.
Yeah.
Compared to bond market. Bond market funds used to be much bigger than equity market size.
Correct.
Because of the various things that bond market is giving better experience to investors. So innovation also came along the way. Like FMP, what you mentioned about when people saw interest rates going up and down, therefore people thought that income schemes can give a positive return, can always give positive return. That got challenged.
Correct.
They started giving negative return because interest rates are going against the expectations.
Correct.
The moment people saw that mutual fund debt schemes can also give a negative return as they are giving positive return, depending upon how the interest rate trajectory is going. That's the time the innovation of FMP came. Then when you say that, okay, buy and hold the securities for a fixed period, the investor also is assumed he is coming for the fixed period. We used to have a 1 year FMP, 6 months FMP, 3 months FMP, 6 months, 1 year, 9 months, and 2 years.
Yeah, I remember.
And
all duration.
All duration used to be there. But those durations, liquidity is actually, it's always given at the cost of exit load. So that's why it got fixed with the assumption nobody will exit.
Correct.
When times of crisis, when 2009 happened, when you know that your own money may be at a bigger risk by staying invested in FMP, then you actually put a redemptions. When you construct the portfolio, I never expect redemptions will come.
Absolutely. Because you expect that the
investment to be for the period of fixed period. But at the same time, investor has got the right to withdraw money within the offer document guidelines.
Correct.
That is when we realized that FMPs you can have, but you cannot have the open and withdrawal. If you come for 3 years, you have to consider the portfolio for 3 years only. The money should mature before even the scheme coming for maturity. This discipline we brought in. And then the exit load is actually of now used to anybody in times of crisis.
Correct.
So that's something we fixed it through the regulatory changes. That's the way the regulation got changed. So regulator also learned, right? Regulator is the bigger advantage of regulation in India. I always say that it got evolved not because they discovered it, not because we identified it or we proacted it. We see it, we struggle. Our struggle is the opportunity for regulator to fix solutions.
Very well.
So every opportunity, every problem used to raise a question mark. Why the problem has occurred? What is that this guy did not do which he should have done? Especially the portfolio manager. What is the mutual should have done which they didn't do it during the period? So all the things not done become part of the regulation. So that's why the regulation got evolved. And FMP is a period where was a good learning in terms of how to structure the product and how to promise yield. Then we used to always say that if you come to the fund for 3 months or 6 months or 1 year, you will get return of say 11%. It's always used to be never been indicative. Because whatever you earn is your return supposed to be. But you can also lose money.
Correct.
Through various means. The sell before even maturity date, you lose money. Sometimes you may gain money. So this gain and loss, how do you represent that? So that is the time the mark to market came even on FMP. Otherwise it used to be, we never used to mark to market it. We will lose it, leave it till the maturity date, thinking that money will stay with us for long. So all this mark to market got further added to the other schemes. Even the liquid fund, money market schemes, initially it never used to be mark to market.
2011.
The moment 2013 crisis happened, then we said even in money market fund I am supposed to mark to market. Therefore, India is the only area where the bond market got fully developed through this learning curve. At all point of time, whatever the learning that we would have had for a variety of reasons like market crisis, global market crisis, financial market crisis, or interest rate going up and down, fiscal deficit going up, and all the things when it created upside down in the bond market in terms of price going up and down on the basis of the yields movement, the mutual fund industry also got further refined and reformed through the policies.
You were mentioning to me some time back, and I'm just going to throw this as the last question to you, which has got very little to do with bond markets, a little bit to do with you, and a lot to do with the regulator. Okay, before we move on to question answers, you were telling me the day you took over, entry load was abolished. Your first day in the office as CEO, that was something which happened.
Correct.
2 years later, Mutual Fund Advisory Committee, I was part of that committee along with you, and SEBI insisted on mark-to-market of liquid funds, which eventually came in. I think then direct plans came in. Okay. When I look back, I think it was a very defining. You called about it as a learning period. Everybody evolved, but it was also a very defining period for the industry, particularly the debt markets. I was just going through my notes. Correct me if I'm wrong. 2014, the mutual fund industry was 10 lakh crores.
Yeah, close
Give
to
or
that.
take.
Yeah.
So very far away from 80 lakh crores at this point of time.
Right.
And a lot of things were being evolved. They were being tested. So two questions. One is a CIO seeing that and saying, okay, this is the only problem which I have, which is managing investments. And the other is CEO. Day one, you have a spate of regulatory changes which you're incurring and then going after that. How did you view that? How did you adapt to that? Okay. And second thing is, from your point of view, as an industry leader, now not as the MD of Birla Mutual Fund, but as an industry leader, how do you think these regulations actually evolved, helped build the industry, build the structure for the industry so that you could have more innovation, more size, more clients coming in later? Am I right? BSE Star MF was also around the same time?
All on the same time.
Around the same time. So a lot of
2014,
things.
2016, 17.
7 Okay, so I'm just saying that period, 2005 to 15, was something which was a new government at the center, regime change which happened. As a MD, how were you looking at this? And as an industry leader, how are you looking at these changes, particularly from the regulation point of view?
Yeah. See, I think each time, I think you put it the mutual fund industry into three bucket, which is 1995 to 2005. You put that is a free ride. Whatever you do, you are a god.
Very nicely put.
So you are a free ride. Whatever the fund
The
manager you
Wild West.
decide, as a sales you decide. You have high entry load,
Yeah.
high exit load. It was a different kind of scenario, completely free kind of market.
Correct.
And then the regulation came.
Ah.
When the 6% entry load was there, then suddenly realized why should somebody pay 6% to come into the mutual fund?
Yes.
Which is Damodaran period was tested. Yes. Then he made that 6% 2%. So that's the way it got evolved. So when this 2012 circular was coming, then I was also part of the committee incidentally.
Acha.
And there are about 15 items were being done as part of the reforms. And one of the items which came is the direct. Some of the items are actually beneficial for the industry, for it to grow to the next level of growth. And there are one or two items actually not, you can say beneficial for industry and investors, may not be beneficial from the distribution point of view. Then where would you draw the line? You want many good things and one or two small things negative, or you want many negative and one or two small things, good things. So out of 15 items, 12 items were growing in nature. So since I come from the investment side, I say all these things are very good for the future of the industry. So I should unnecessarily object.
Correct.
For small stuff which is not in your favor, and if you say no for the rest of the stuff, then you are doing an injustice to the industry for the growth point of view. So I quietly asked SEBI that point of time, regulator, we are giving you so much, don't object for all these small things, let it go. Then it took off. Though we had to pay, we have to face the market.
Yeah.
But fortunately, the growth aspiration and growth, what we are seeing, was bigger than the problem that we had in our hand. So that's why when I took over from investment to a CEO, what came in handy for me, when an investment guy, you look at always the growth of the future. As a CEO, you always look at the mix of both. You have to also manage your regulatory expectations and so on and so forth. Since I came from a investment background, I only looked at the opportunity that industry can tap, and even as Ayatollah some mutual fund, that was there in the mind. Therefore, I never bothered that these regulatory changes is actually will spoil the game. In fact, after all the regulatory changes, in the MF industries became larger.
I couldn't agree with you more. I think, and my interaction with SEBI over 6 years in the Mutual Fund Advisory Committee actually gave me a very similar insight. These are very smart people and they have a global lens. So sometimes we may not be able to understand what they're trying to say or do because we have our own vantage point when we're looking at them. But if you just step into their shoes, Sometimes, of course, they need more data, they need to be having more insights, but by and large, I think they're in favor for the growth of the industry, which is exactly what is happening.
Correct, correct. Therefore, these regulatory changes, which I always used to think it's a constant, and we have to live with that. That is something is being created, keeping in mind the growth of the industry, not keeping in mind your interest, individual interest. Even as a when I started playing the role part of the Amphi as well, so I used to disconnect between the selfish goal that I may have related to our own organization versus the industry goal. If industry's goal is actually bigger than your selfish goal, you actually focus on that first rather than your selfish goal.
Correct.
Yeah.
No, I remember that, Bala. And before we open it to questions, when the 2 basis points to be spent on investor education happened, there was a lot of debate which was happening in the Amphi board, and I was also part of the debate. I remember you having said that what is the problem? It will help the industry grow. Of course, we also have to spend money. Okay, we also have to pay 2 basis points, but it will help the industry grow. I remember that point. You were wearing 2 hats at that point of time. Yeah, I remember that. Wonderful, Bala. It was extremely interesting talking to you. Before we just ask the students to ask some questions, anything else you'd like to leave the audience with in terms of your experience and what to expect from the markets going forward, not in terms of returns, but how do you think the mutual fund industry growing?
Something will become one of the primary investment vehicle. I say that the way the banks used to be the primary investment vehicle for every savers in the country, mutual fund will become a savings vehicle. This will become a primary investment vehicle. This will also become a vehicle for meeting the goals of every citizen of the country on variety of forms. And there is also industry which will create wealth for over a period of time. And mutual fund industry is the true representative of the proxy of the Indian economy. And if Indian economy does well, mutual fund industry will do well. And the returns are directly linked to the GDP growth. So nominal GDP plus 2% is the return expectation that you could have an equity. And fixed income anyway is the return ranging from say 5 to say 8% kind of range. So as long as you understand this model and then treat this as a primary investment vehicle, I think the industry will continue to be the larger and larger. My own belief is the next 15 years, 20 years will be even bigger than the banking industry size in India.
And I might dare say that there is a Tina factor. There is no alternative. You cannot find a better alternative if I want to channelize your sales.
Correct.
And you talked about the industry. Let me end with a personal note. Congratulations on touching 4.5 lakh crores. I think that has been a dream for you. And, many congratulations.
But it's still short of our expectations.
That always, Bala, knowing you, that is always going to be short of your expectations. But I feel nice.
Correct.
I was in the company when the aim was not even five-digit crores.
Now, I still remember to cross 10,000 crores how we all fought.
Yeah. So those are the days. Thank you so much, Bala, for your time.
Thanks, Vikaas.
Would you have some questions? Anybody wants to ask any questions?
Hello, sir. My name is Siddhi Ghadigaonkar. So my question is that what major trends do you see shaping the India's debt mutual fund space in the next few years?
I think in mutual fund, the trend that changes comes is, so today is no more awareness creation is important for MF industry. MF industry is now well understood and from a product point of view, a savings vehicle point of view. So mutual fund can also become a solution provider. So I think my belief is over time, mutual fund will start playing the solution provider to every needs of the citizen in the country. Basically, it can become a caretaker of everyone's money in the country in terms of savers. That's where the mutual funds could evolve. Where we started as a product-driven mutual fund. I think today's conversation was more about debt as a category, which we discussed about. In this way, I think industry got developed. As we move forward, it will become asset allocations. It will become more solution-driven approach. Second is the investor's point of view. The way information today is available using technology. I think technology will play a very large role in giving all the insight and information on one click to the investors. Therefore, taking care of the investors' expectations through the regular communications, effective communications using technology also become the key to the success of industry.
Hello, sir. My name is Rushil Sharma. And my question to you is that we know that day by day investors are becoming more aware about various form of investments. And I've been myself hearing about ETFs and mutual funds and other form of investments. So, like according to you, will ETF will be better in today's era, or mutual fund will be more better? And in terms of future, also like ETFs are growing day by day. So, what is according to you, what will be better for a future form of investment, ETFs or mutual funds?
In fact, there is no difference between mutual fund and ETF. Both remain the same, except mutual fund products. Rather, the products are divided into two parts: actively managed funds versus the index-based funds. You hug the index, therefore ETF becomes as a product, and both are given by the mutual fund only. So I call it the both will coexist. So mutual fund active managers, it charges the fees as defined by the regulation. That can vary from 1% to say 2%. Whereas in the case of an ETF, since you're only hugging the index, and there is no other work that you do other than hugging the index and replicate the full index, therefore these charges actually lower fees. But if the market remains bigger, if the India continues to grow, and then breadth in the market also improves significantly, more and more companies will come. Nobody would have imagined about say 4 years back, there will be a company like Zomato will exist in the market. There will be a company like Nykaa would exist in the market. See, all these companies, new companies have come. So when these new companies come, they create a huge amount of value. They are not part of the index. When they become part of the index, only when they become bigger. So therefore, index always representative of the bigger companies, established companies. Whereas money manager jobs to actually go and look for a company which can generate actually wealth more than the index. So that's why the active and passive both will coexist. ETF comes in the passive category. Active comes in the category of money managers giving their best to generate return better than the index. Therefore, from investors' point of view, both will coexist. I always say both the products should be chosen for investing in order to have diversifications. Both will remain as a category. But from a funder's point of view, from a mutual fund point of view, it is our duty to ensure that we give all products which the customer can pick and choose depending upon his choice, or all products can be considered part of the investment bouquet of products that he will choose. And therefore, it should be part of the product availability in every shelf. That's what we look at.
Hello, sir. Kanaya this side. Suppose someone wants to build a career in buy-side analyst. So what are the key skills required or to be successful to become a buy-side analyst?
See, for a buy-side analyst, of course, one has to create deep understanding sectors, analyzing companies, knowing about in and out of the balance sheet construct, how the business is being constructed, and how the allocation of money is being done from the business point of view. How one is able to judge how the sustainable business it could be. Because everyone can start a business whether it's sustainable in order to build a scale. Then what is the aspiration of the management and deep commitment of the management to build a scale? So all those things should come as part of the analytical capability. This analytical capability will come only upon one being passionate about investing. Second is go deep dive in terms of finding an answer for all these questions that comes in your mind, which will make the company becoming bigger and bigger as the future happens, as the progress in future. So all we have to find an answer for that. So as a buy-side analyst, one should be able to bring those kind of qualities. In addition to that, how one is able to assess the industry dynamics. So industry dynamics can change. And if it is a monopoly, it's easy to identify. If it is a non-monopoly, there are many players will be there within that you have to choose. Then one is able to differentiate in terms of the vision of the company, the management, and basis which build those kind of quality as part of the individual, I call it the characteristics of individual they should build. And one must only remember that pi is actually, so I call it the fundamental community is a very small community. It's not a big community. Therefore, one has to be keep that in mind that we want to be part of a small community, which essentially means would be a lot of competition within the space to get in. It's like IIT versus non-IITs. The non-IIT is not bad, but there are only limited seats in IIT, right? The same concept exists in the fund management side. Limited seats will be available. So within that, one has to get, then one has to build this kind of capability and characteristics as part of the quality.
Thank you.
They say that debt markets don't reward noise, they reward discipline. What is true of debt markets, we're seeing a manifestation of that in our guest today, a man who has been working very, very silently behind the scenes, and you would have heard him talk throughout. His depth of knowledge, his breadth of experience, and more importantly, his contributions, however modest he may sound, but his contributions to developing the Indian mutual fund industry debt market has been immense. Thank you so much, Bala, for coming here. It's been a real pleasure hosting you. Thank you so much.
Thank you, Vikaas.